Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines. At least 1,765 people have now died from the coronavirus epidemic. The Hubei province reported 2,000 fresh cases and 100 more deaths. Telecom operators Bharti Airtel, Vodafone Idea and Tata Teleservices are going to pay adjusted gross revenue dues today to avoid punitive action, according to the Press Trust of India. All India will approach the Telecom Appellate Tribunal this week against the AGR dues sought from them. Other companies likely to move the TD SAT are GAIL, Power Grid and GNFC. The Reserve Bank of India's board has recommended a shift in its accounting year to April to March in line with the government's financial year. It currently follows a July to June pattern. And India's trade deficit widens unexpectedly in January to $14.73 billion as exports fall for the sixth straight month and there is a decline in import eases. Well, let's take a look at the trade setup for the day. The world markets and the US markets ended flat in Friday's session. Hardly any movement there. For the week, they may have ended in the green, but the Friday's trade was very, very flat. But led by the Japanese GDP numbers, Nikkei is leading the charge on the downside for a couple of these Asian indices, though you would have to say that Shanghai and Hang Seng are actually in the green. So it's a mixed bag. Because of the GDP data, Japan is not doing all that well. The other markets doing okay for themselves. The SGX Nifty indicating a start which is very, very flat in trade, and almost one single worry, and I don't need to tell you that, but one single worry across markets, and that's coronavirus. Though, as per this chart on the Bloomberg terminal, and this calculates on a day-on-day basis that compared to the previous day, what's the number of coronavirus cases that are confirmed each day. The number is still very high. So you look at 4 red bars and think that at least the confirmations are coming off. But still, if you just look at the size of the bars, it tells you that the number of cases getting detected each day is not fallen below average. If anything, it is still above average, and that should be a worrying sign. The kind of impact that it has on growth is pretty severe. And frankly, with all this around, it's very unlikely that the Indian markets will have a substantial uptake or a sizable difference compared to what the global markets are doing. Yes, Shanghai and Hang Seng are marginally in the green, about 0.5%, but you never know when that might change as well. So please be careful while you're trading what the markets are doing in today's trade. The OI distribution too suggests that traders, for the week at least, are not really betting on something which is substantially different from what the last couple of weeks have shown. And as we near the weekly options expiry, you will see this range narrow down as well. Foreigners which were not trading very heavily, a couple of days of large inflows happened, but in Friday's session there was a bit of an outflow as well that came in from the FIs. Net, what I'm trying to say is that it's very unpredictable to try and take a bet on what the index could do, as our experts say on the platform as well, and therefore we're foolhardy to try and take a range or take a guess as to what the markets would do and from where you should start doing some bottom-up fishing. Maybe it pays to stick to specific stocks, and I think telcos would be firmly in focus. Bharti, Vodafone as well as led by Tata Tele, TCS would be firmly in focus as well in the session. I'll talk about that why, but Bharti Airtel and Vodafone Idea in particular, let's wait and watch if the divergent moves continue. Let's talk about results. Balkrishna Industries, yet another company where the revenue growth wasn't the most impressive. In fact, the revenues came off and maybe the markets get disappointed with it marginally, but the operational performance was just so strong. Look at that EBITDA margin expansion, and as a result of which the net profit went up 48%. Let's wait and watch if this one reacts positively. Muthoot Finance, steady state. You would have expected this after what Manappuram has done as well. Gold finance companies are actually doing remarkably well on the business front, and maybe that's why Muthoot Finance numbers too looking very impressive. We'll talk to the management too a bit later on in the day, but do watch out for Muthoot. Should be an interesting one to monitor in the session. 2 weak numbers. SAIL EBITDA per ton was the lowest in the last 10 quarters. And with realizations falling 21%, they clocked in the lowest tick since Q1 FY18, nearly about 8.9. So it's not been a very great time for some of these companies in the metal space, and SAIL is no different. Edelweiss, again, not that too many people would have anticipated good numbers, but just the extent of damage. Look at that, net profit collapsing 92%. They're involved in a bunch of things as well. They're going to approach the Securities and Appellate Tribunal against NSE's order. So lots happening with Edelweiss. Very difficult to see how would somebody take a bet on this one right now. 88 is where it's trading. Let's wait and watch if it gains a little bit or does it get meted out fresh punishment in the session today. As per Bloomberg News, there's a strong response to the OFS of Avenue Supermarts. The non-retail investors bid is 3.4 times the demand on day one. Let's wait and watch if this one sustains or does it succumb to more pressure. And lastly, like I mentioned at the start of the stocks to watch piece, that the telcos are going to pay the AGR dues. TCS was in focus in Friday's session because the market would, in its wisdom, believe or speculate is the right term actually, that Tata Sons will use some dividend from TCS in order to raise the ammo for paying off the dues, and therefore TCS could remain in focus in the session today as well. Was under pressure compared to the rest of the IT pack in Friday's session. Let's see if today is any different. But mind you, watch out for this stock in the session today. Okay, let's tell you what's lined up on First Word today. The top editorial stories that we want to bring to you. End of the earnings season, Darshan Mittal bring us the corporate earnings scorecard for Q3 FY20. Piramal Capital's decision to lower its real estate exposure may help lower the company's interest rates. Advait Rao Palepu will get us his details. Catholic Syrian Bank's fortunes have changed since its listing for the worse. Shefali Malik will try and explain why. And asset management company stocks have been on a tear recently. We'll look at what's working for these companies. We have wrapped up the third quarter earnings season and a majority of companies managed to live up to expectations. Darshan, as always, is standing by with the scorecard. Darshan, midway through, we had done a small analysis. How is the end of the season looking?
Yeah, so I think one change is we always do it at the end of season, but this time we will only have to do with 49 companies because Yes Bank has delayed its number. So it'll be a fair-to-fair comparison. We've left out Yes Bank from all. So it's 49 companies what we've seen. It's not been the best quarters this time around. 10 companies came out with strong numbers, 12 in line, 27 in line, and 12 weak. But let's take a look at comparison. Obviously, Yes Bank delays its results to March 14th as it's engaged in the capital raising plan. So it's 49 companies. Now the trend, if you're looking at it, what's happened, if you do a like-to-like comparison from the third quarter, you can see that the numbers from 20 has gone down to 10. Even if you do on a quarter-on-quarter basis, gone down from 16 to 10. And the number of weak companies have risen from 9 to 12 and from 11 to 12. So overall, not the best call. I think the first quarter was the weakest. But overall, if you do a like-to-like comparison, it's not been a very, very strong quarter. It's been a very, very average quarter this time. Earning growth has simply not come in. So that's the broad trend that we're looking at. In terms of companies which came out with strong set of numbers. Basically, a lot of these NBFCs came out with strong numbers. Couple of these IT companies came out with strong numbers. So that's the trend. If you're looking at it, auto continues to remain weak. Reliance was weak this time around. L&T was weak this time around. We don't see Kotak too much on the weaker side. A couple of private sector banks. Actually, banks disappointed a lot this time around. And majority of the other companies pretty much in-line set of numbers.
So since banks have disappointed, let's try and take it down to sectors, Darshan. Which sectors did well, which sectors did not? Yeah,
so let's start with agri first. UPL came out with numbers, and that's the only company that on the agri side. Strong set of numbers, gained market share in key markets, maintained revenue and EBITDA guidance. Their synergies with the Arista acquisition have finally started to come in. So that's the trend that you're getting in on UPL. The other one is the automakers. This time around, failed to impress. You had Hero, which Bajaj probably was the best, and that was on account of strong exports. Cost saving was something that aided Hero MotoCorp. Eicher was in line, the negative operating leverage clearly impacting the numbers. But overall, if you're looking at it, Maruti disappointed, Mahindra disappointed, Tata Motors also disappointed. So auto as a sector didn't do well. The next sector that we want to talk about is the cement sector. Ultratech, I think the numbers were in line, but I think the stock did rally because the commentary was strong and the volume growth was strong. But overall, as a sector, cement hasn't been one of the best performing sectors this time around. Again, construction, L&T was the only one. Misses estimates but maintains the guidance. They believe even though it will be a tall task in the fourth quarter, they have maintained the guidance. The order book growth was coming in at the cost of lower revenue. So they were taking in orders, but the revenues were not coming in. That's why there was a revenue miss that came in on L&T. Consumer firms, yes, if you're looking at it, it was in line. I think the volume growth was strong for HUL, ITC, as well as Asian Paints. But I think the commentary that came in was that rural demand is not picking in. There is a lot of weakness there. So overall, urban faced companies probably did well than the rural side of the company, and that was also evident from what the management said, that typically when rural grows 1.25 to 1.5 times of the urban side, in the fourth quarter rural grew half the time urban did. So that's FMCG. If you're looking at the oil marketing companies, mixed bag of the numbers. Petchem and Jio both was weak for Reliance. GAIL probably did extremely well this time around, better petchem and transmission income. BPCL, higher refining capacity utilization aided the company, but for HPCL and IOC, the lower gross margins and refining shutdowns impacted the numbers. So it was mixed bag, nothing much coming in except for GAIL, which rallied significantly. Now, in the banking side, I think NBFCs did extremely well. If you're looking at the sector as such, weak asset quality and higher slippages was seen on the bank side. Even the private sector banks faced a lot of heat this time around, and the majority of the bank reported weak loan growth. Even for an IndusInd or a Kotak, even for HDFC Bank, I think the loan growth probably was not the strongest this time around. Coming to IT and on the banking side, I think the NBFCs did well. Your Bajaj Finance, Bajaj Finserv, HDFC, they did well this time around. On the IT front, I think it was okay. It wasn't all that bad. If you're looking at TCS, revenues fall in the BFSI and North America segment. HCL did well. They've increased the guidance. Infosys did well this time around. Wipro continues to do have cost pressures, and that impacted the margins for Wipro. That's the IT pack. On the other one, Z, I think ad revenues were weak, costs were much higher. Nothing much to talk about. Obviously, there are other issues that surrounding Z rather than the earnings front. So that was Z. A couple of other sectors is metals. I think metals, except for Vedanta, which did well. I think steel prices were weak. But Tata Steel, JSW Steel, both of them reported weak set of numbers. So that's the trend on the metal end of the market. Pharma, I think it was decent overall. For Dr. Reddy's, no doubt was decent. Sun and Cipla, overall the internals were decent. India business and US business, both of them did well for the company. And finally, I believe on the telecom side, I think Bharti Infratel, higher exit charges, and there was energy spread. Airtel was really good. Africa, the home broadband and the enterprise, all of them did well for Airtel this time around. And a lot of clarity came in on the AGR dues, where they given clarity on the con call. So Airtel probably will be in focus today also.
Yeah, and probably the last time that we're talking about media as a sector on the Nifty, because next time onwards, Z may not be in the Nifty or will not be in the Nifty. But Darshan, thanks so much for putting that into perspective. So, well, not as great as what the last quarters have been, but let's see if for the year end, we clock in about 9 to 10% of growth. Remember, Gautam Digad of Motilal Oswal in their interaction with us in Friday's session, when talking about the numbers, said that with what's happened in the first 9 months and the expectation of what banks could do in quarter 4, we might actually clock in about 10%, which will not be bad considering there were doubts around this number as well midway through the year. Time will tell. Okay, let's move on. Non-banking financial institutions have had a tough time over the last few months, as financial institutions with large wholesale loan books have had to offer higher yields to attract bond investors. One such NBFC is Piramal Capital, which has in fact made it clear that it's looking to lower its exposure to realty developers and turn focus to the retail loan book instead. The recent moves have also helped it raise funds at a slightly lower rate from a corporate bond market. Advait has these details. Advait, pretty interesting for what was considered to be the prime real estate lender to now start turning focus as well.
Yeah, so ever since the non-banking financial crisis started in September 2018, a lot of the NBFCs that had a large chunk of their loan book concentrated to real estate developers, whether it's commercial or residential, have now turned to the retail market because the yields are probably better there and it's a lot safer as a market. So Piramal has grown its retail loan book, which is mortgages essentially, while it's scaled down the developer loan book. They've also restructured some of these loans. They've also taken some of these loans and sort of, because of their contracts, they've been able to sort of replace borrowers. So overall, they've restructured, deleveraged by raising equity as well. So as from the group entity perspective, they've raised around 14,000 crores of worth of equity through a rights issue as well as stake sale in Shriram Transport as well as in a healthcare business arm. This has helped deleverage the firm by about 2 times. So it was at 4.6, it's now at 2.2 in terms of the debt equity ratio. So the bond markets do like this, that the company is turning around. The earnings are also better. But what's most interesting is that they're moving the developer book to an alternative investment platform. So that essentially moves the risk away from their creditors for their bond market investors. So as a result, their spread, which is the difference between the rate at which they can borrow from the bond market and the GSEC rate, has come down from 350 basis points in June or so to below 300 basis points now. So it's about 70 to 100 basis points reduction in their cost of borrowing from the bond market. What bond investors have told us is the companies that deleverage, raise longer term debt, reduce their short term borrowings, restructure their loans, reduce their asset quality problems, are the ones who are going to gain the advantage. So initially you had AAA corporates or AAA NBFCs were able to raise from the market, then the retail NBFCs such as gold loan financing, the vehicle financing NBFCs were also getting money. But slowly the tide seems to be turning towards the wholesale developers, the wholesale developer NBFCs, because the risks in the real estate, which were quite heightened amongst the market players, that they were thinking that the real estate exposures of these NBFCs could really bring down these companies, but that hasn't played out. So you're slowly seeing the transmission of rates come back to the wholesale developers, Piramal being the one who's gained the biggest advantage so far all this while.
Okay, one follow-up, Advait. Piramal probably didn't have a choice, right? They would have to do this in order to gain some access to the capital markets to raise funds. And part 2 of my question, even though the rates would have come off a bit from the peak, they'll still be higher than what comparable NBFCs and even the gold loan or the vehicle finance business are getting? Yeah,
it is still higher than what an HDFC and L&T Finance that have 70-80% of their book mainly concentrated in retail loans, whereas Piramal's the other way around. But the fact that they've ramped up their retail loan or the mortgages book is actually much more beneficial for their creditors, because the creditors feel that these books are granular, the risk is lower, it's not concentrated, whereas before they had a large exposure to the top 10 developers held large exposure to the company, so that became a risk problem. As far as compared to other NBFCs, yes, the rates will be higher, and obviously the GSEC has moved down since the early days, and especially in the NBFC crisis when we saw the bond market rates move up by 200-300 basis points. It's still elevated, but clearly the advantage to companies that restructure, deleverage is playing out, and bond investors are now opening themselves up to this. Plus there was the FPI hike limit for corporate bond investment that was made in the union budget. So you could see flows coming in from there as well. And because they've been able to raise equity, especially from institutional investors like CPDQ of Canada, these names, the corporate governance part is also playing a big role in determining where bond investors put their money.
Yeah, well, if there is a reasonable margin of safety and a much higher yield, which bond investor may not want it?
Exactly.
Great. Advait, thanks so much. Very interesting story. Thanks so much for putting this into perspective. Well, interesting. A lot of people would have raised question marks about some of these NBFCs' ability to garner funds. Piramal, by change in tact, is able to get it at a lower cost than what it used to maybe 6 months back. Okay, well, if there is good luck for Piramal, not so much for Catholic Syrian Bank, which was a very sought after primary market offerings last year. The Fairfax-backed bank saw its IPO being subscribed 78 times. Not surprising that it's also listed at a substantial premium. But since then, the fortunes have changed quite dramatically. Shefali Malik is here to tell us why. Shefali, when Catholic Syrian Bank listed, everybody said that related banks would move up. Now, while the related banks have not moved up, Catholic Syrian Bank, from its listing heydays, has actually come off. What's happening here?
Well, even at the time of listing, there was a lot of fanfare, a lot of exuberance, and a lot of positives as well. It was not completely empty. But then, even at that time, what we did point out was that the valuations were expensive. So, a lot of factors worked at that time. The market looked at the positives, which is a very strong promoter, very healthy market conditions. In fact, most of the IPOs that came during those 1, 2, 3 months got a very strong response. So, CSB Bank, because of the strong promoter hand, got a very strong subscription to the IPO, and also there's a turnaround story. So which is that in last 3 years or so they reported a loss, and in this quarter and in the first half they actually turned around. So market believed in that story, but at the same time, so now what's happening is that now the actual comparison is being made. Okay, now the listing is done, so now how the bank is faring, and now it's more of valuations coming off and normalization happening. So street gaining senses, you can say. So because of that reason, the valuations have come off. So you look at the valuations, I've taken FY20 estimated valuations because FY21 projections weren't available for the same. So for FY20, based on the September quarter, for CSB Bank, the price to book was 2.2. Now that has come off to 1.95. And look at some of the other banks. Federal Bank, which is the closest peer, 1.22, which is 1.33 now, and City Union Bank, which is again a South India based player, 2.9 times at the end of September quarter, and now similar price to book. And I've taken two mid-sized banks as well, DCB Bank and RBL Bank. DCB Bank around 1.8, 1.7, and RBL Bank around 2. So it is in comparison to all these players, all the other players have been consistent performers. Leave aside DCB and RBL, they have faced issues in the recent past because of the corporate book. But aside of that, in last 3 to 4 years, they have delivered very good performance. And for them, and that is getting reflected in the ROA performance as well. So for CSB Bank, the ROA at the end of December quarter stands at 0.6, and in the previous 3 years, it was negative. Whereas for Federal Bank, again, it has been consistently inching up. So they have been delivering ROA of 1. City Union Bank again over 1.5, and same goes for DCB Bank. For RBL Bank, it has come down sharply because of the corporate book issues in last 9 months or so. And if you actually go by just the pure operational performance, for CSB Bank, the turnaround story, the street actually needs to see more of that, because in last 3 consistent years they reported losses. So they only came to profitability at the first half of this year, and even in this quarter, so first 9 months. So more needs to be seen whether they can consistently deliver profit. And so that's the real comparison that's coming in. And so actually the street actually looked at the Q3 performance, or the most of the analysts who've been tracking it. So they reported the highest NI and PAT performance in Q3 vis-a-vis these names that I mentioned. And the gross NPAs, however, inched up 36 basis points, whereas for most other banks, barring an RBL Bank, they were just plus minus 10 basis points or so. For RBL Bank as well, if you remember, I did point out that in Q3, even though the results were weaker, but actually the street is taking that well, because now as per the interactions with the management, the analysts tracking it do consider that probably the worst is behind for them, and most of the corporate book issues are largely dealt with. And the most notable point in their earnings is that the loan growth and deposit growth for them is actually the weakest this time among peers.
The RBL you're talking about?
No, CSB.
Okay.
So for CSB Bank, the loan growth this time in Q3 was 9% on a YY basis, and a degrowth of 4% on a sequential basis. Whereas for most of the other banks, it was 10 to 20% on a YY basis. And for deposit growth, it was 3% YY and minus 2% on a sequential basis. So weak business momentum coming in actually for them.
Well, no wonder. Just look at since listing. I mean, if we just pull up the chart of Catholic Syrian Bank, the last 6 months, 3 months, whatever chart we have, and you will see that largely, if you would have been invested in Catholic Syrian Bank at any point of time in the last 3 months, you would have already lost money. Last 1 month too, about 15%. So, not the best of times for somebody who invested into CSB Bank after it listed. Let's wait and watch if it finds favor at some lower levels. But Shefali, interesting analysis. Thanks so much for putting that into perspective. Well, speaking of analysis, a group of stocks that have been doing very well are the pure play asset management companies. Let's take Arnam or Nippon Life AMC now, as it is called, for example. It touched a new high on Tuesday and largely has remained buoyant. While corporate earnings were one trigger for the AMC players, the January AMFI data has provided another leg to rally. And let me try and explain why. Now, just look at what these stocks have done in the last few days, and while they have been steady over the last 3 days, there was a bit of a surge which took Reliance Nippon Asset Management to all-time high levels, which took HDFC AMC back to those 3350, 3400 levels. So there was a bit of a surge into these AMC names in the last few days for sure. Now, why are the, I mean, aside of the numbers that they both of them clocked, which was very good, the flow of equity funds, and why I think is particularly important is this. Now, just look at the data for November, December, and January, and you will see that there was an uptick in almost all the equity linked components. So large cap equity funds showed an uptick, decent numbers there, but look at the mid caps and look at the small cap numbers, especially in the month of January 2020, wherein the mid cap numbers were about 1798, the highest in the year thus far. The small cap number was 1073, which is amongst the highest levels this year. There were a couple of months which were high, but as a trend, I think this was the highest number in lieu with the mid cap space. And the multi cap funds as well had a very high number in this month, which is 1722. So all in all equity linked funds actually got higher inflows. And why is this important? There's a Goldman Sachs note which says that the steady rise in the net new SIP registrations lends a strong support to domestic flows and likely to see a continued pickup in domestic equity flows as economic growth improves in the coming months. Now remember why this is important, because equity funds or equity exposure or equity flows into mutual funds gives them a bigger bang for the buck in terms of the earnings, and that's why AMCs with a higher equity percentage of profile tend to gain more. Let me try and illustrate this. Reliance Nippon or Nippon Life Asset Management Q3 highlight, if you saw, there was an increase in equity mix, yes, but it was negated by a 7% quarter-on-quarter decline in the debt AUM, and PAT was driven by higher MTM gains on equity portfolio. So if indeed the equity portfolio is driving gains, and then if the equity portfolio is seeing more money coming in, you would want to presume that the bottom line performance of these funds would actually improve. And therefore, while the price to earning multiple for Reliance Nippon or Nippon Life Asset Management would be higher than what it has ever been, I think the market seems to be liking it, and which is why it's willing to pay this premium. Look at HDFC AMC, for example. Q3, there was a lower growth in actively managed equity AUM, but the long tenor SIP book mix was higher on a quarter-on-quarter basis in favor of the equity linked funds, and as a result of which, if indeed HDFC AMC is able to maintain its equity exposure on the equity funds, it's by far the highest, then the market will be willing to pay the premium that it is paying. So these two did very well. There was also some surge and then a pullback into Motilal Oswal and Aditya Birla, because they are not just on the basis of their asset management business, which of course for MOSL, for example, did very well. For Aditya Birla, it was okay, but the other businesses dragged down. So when you look at the asset management companies, somehow the market is veering towards the pure play asset management companies as opposed to a Motilal Oswal or Aditya Birla Capital for sure. MOSL has still gained a little bit in the last few months, but Aditya Birla Capital has stayed at these sub 100 levels now for a while. It goes up and then tends to pull back a bit. So the higher equity mix, and arguably if that continues, then brokerages like Goldman Sachs, for example, believe that that should only augur well for the asset management companies. Let's wait and watch if there is more gains in store for some of these. That's all that we have on First Word today, but lots more lined up on Indian Open. Ajay Srivastava of Dimensions Corporate Finance joins in to talk about elections, markets, and macros. And of course, we try and speak about earnings with K. Memon of Muthoot Finance and Ramesh Agarwal of Rupa & Company.